How to reverse engineer Berkshire Hathaway in the modern day. Berkshire Hathaway over the years has been able to maintain a Sharpe ratio of under 1. Over the course of time, this has been more impressive than any other stock or mutual fund with a history of more than 30 years. Further, we can estimate that Buffett's leverage using Berkshire Hathaway is about 2 to 1 on average. Buffett's returns appear to be neither luck nor magic, but rather reward for the use of leverage combined with a focus on cheaper, safe, and high quality stocks. I can now break down Buffett's portfolio simply by seeing that his portfolio contains publicly traded stocks and wholly owned private companies. In most cases, stocks outperform wholly owned private companies, which shows great stock selection is key compared to his effect on management. There has been a plethora of information written and said on Warren Buffett and his investment philosophy and style, however. There has been limited rigorous analysis that has been able to explain his performance. In my investment philosophy, I utilize many of these key components and use leverage to great use. The impeccable success attributed to Warren Buffett has become the main focal point of emphasis in debates involving market efficiency, which continues being the center of conversation in financial markets and economics. In the modern day, we can begin to wonder if the same results and returns can be executed by a real-life investor after taking factors like transaction costs and funding costs. The answer in most cases is a resounding yes. Based on Buffett's performance and the decomposition of it, Buffett continually utilized all of an attractive return stream by picking stocks for the use of low-cost leverage, which is paramount. How does Buffett achieve this attractive return stream that can be leveraged? The breakdown of his portfolio includes the buying of low beta and low volatility stocks, which are considered safe, that are relatively cheap and have high quality, which means they are profitable and stable. In most cases, stocks that contain these general characteristics, like low risk, cheap, and high quality, tend to generally perform well, not just the best ones that Buffett buys. I cannot emphasize enough that explaining Warren Buffett's performance with the benefit of hindsight that still does not discount his outstanding accomplishment and success. Also, I need to consider Buffett's skill being due to his ability to buy the right stocks versus ability as a CEO. The ultimate question is if Buffett is an investor or a manager. To comprehend this, we decompose Berkshire's returns into investments and publicly traded stocks and wholly owned private companies he runs within Berkshire. The main idea is that the returns of the publicly traded stock is mainly driven by Buffett's stock selection, whereas the wholly owned private companies have a larger effect on his management style. Both the public and private companies contribute to Buffett's overall performance, but in most cases his portfolio of public stocks performs the best, suggesting that Buffett's skill is mostly in stock selection. However, Buffett relies heavily on wholly owned private companies, including mostly the insurance and reinsurance businesses. Why is that? One explanation can be that this structure provides a steady source of financing, allowing him to leverage his stock selection ability, which has been shown that approximately one-third of Buffett's liabilities consist of insurance float with an average cost below the T-bill rate. To sum up, I conclude that Buffett has developed unique access to low-cost leverage that he has used to be able to invest it in cheap, safe, and high-quality stocks, and that these key characteristics were important to his impressive performance. Further, both value and quality predict returns, and both needed to explain Buffett's performance. This impressive performance demonstrated by Buffett appears to occur due to a combination of value and quality investing implemented in an actual portfolio, not by magic or luck. Buffett's performance is truly outstanding seen in this perspective. Seeing the results now, if you could time travel and pick a stock in 1976, the best bet would be Buffett's Berkshire Hathaway. Buffett's large gains can be attributed large to his quality Sharpe ratio and his ability to use low-cost leverage to magnify his returns. Reading the general balance sheet as an investor, you can see the asset side contains publicly traded equities, privately held companies, and cash. The basic balance sheet of Berkshire Hathaway contains assets that contain publicly traded equities, privately held companies, and cash. His uncanny ability to have low-cost leverage throughout the years has been paramount to his success. The skill of utilizing this type of leverage explains why Berkshire Hathaway realizes a pretty high volatility despite investing in a number of relatively stable businesses. Also, it is key to consider the sources of leverage, including their terms and costs. Berkshire Hathaway's debt has been rated highly, showing a AAA rating from the years 1989 to 2009. Berkshire Hathaway has shown low financing rates throughout the years impressively, and Berkshire Hathaway has issued its first ever negative coupon security in 2002, called a senior note with a warrant. Berkshire Hathaway's cost of leverage can be attributed to its insurance float. This unique cost of leverage has you collecting insurance premium up front and later paying a diversified set of claims, which is comparable to taking a loan. It's evident, but Warren Buffett's low-cost insurance and reinsurance business has provided a competitive advantage, which gives him access to unique cheap-term leverage. On the liability side of the balance sheet, we can see 1/3 is attributed to insurance float, with the remaining liabilities including accounts payable and derivative contract liabilities. Berkshire Hathaway has notably sold a number of derivatives contracts, including writing index options contracts on the major equity indices, which were in the form of put options and credit default obligations. Berkshire Hathaway's sale of derivatives serves as a source of revenue, as well as a source of revenue which can make these derivatives quite expensive. Investors that use leverage will typically pay a premium for instruments that embed leverage, which includes, in most cases, option contracts and levered ETFs. Warren Buffett knows he can profit from embedded leverage because he has access to low-cost leverage, which is stable and cheap financing. Financial instruments that contain embedded leverage include options and leverage exchange-traded funds. This embedded leverage can alleviate investors' leverage constraints. Therefore, it lowers investors' required returns. I can conclude that asset classes with embedded leverage offer, in most cases, low risk-adjusted returns, which means higher embedded leverage is correlated with lower returns. A significant component of a financial instrument is its embedded leverage, which means the market exposure per unit of committed capital. Embedded leverage is crucial for investors who do not have access to low-cost leverage, which is stable and cheap financing. This need for embedded leverage arises from investors' inability to use enough outright leverage to get the market exposures they would like. For example, most individual investors in pension funds may not be able to use any outright leverage. Most banks face regulatory capital restraints,